Hello everyone, and thank you for joining us today for our Chartered Insurance Institute webcast with Flaxman Partners. I'm Catherine Kennett, Policy and Public Affairs Manager at the Chartered Insurance Institute, and I would like to welcome you all to our session on claims and underinsurance and average outcome. Underinsurance is probably the most frequently encountered problems in general insurance claims. It crops up in property claims as well as business interruption and often leads to very disappointing outcomes. Inevitably, the insurance industry is blamed for this, but is this such criticism always called for? What responsibility should be borne by the policyholder? We have with us online today Roger Flaxman, Chair and Principal Consultant, and Michael Wilson, Director at Flaxman Partners, who I'm sure a lot of you attending this webinar will have already seen before. And if you haven't, I would highly recommend going back to our content hub and looking at some of their past webinars, which have proved incredibly popular. There will be time for questions at the end of the presentation, so please feel free to use the question box you can see on your screen, and we will work through these once the webcast is complete. So without further ado, I'm going to hand over to Flaxman's.
Good morning and welcome once again. I'm Roger Flaxman, and with me as ever is Michael Wilson. In 2015, the British Insurance Brokers Association, in conjunction with insurers Chubb and Hiscox, reported that some 80% of UK properties were underinsured. More recently, Sedgwick's, the loss adjusters, reported that 85.5% of commercial properties they viewed were underinsured by, on average, 28.4%. In our capacity as experts to the courts and advocates, insurance advocates, we'd say probably some 50% of the disputes we see are about underinsurance. And I think it's therefore fair to say that, and we probably all know this anyway, that underinsurance is rife. And the causes and the reasons for it are many and varied. But let me give you some examples of what we regularly come across. Very often it's the failure of the customer to understand what a sum insured represents, i.e. the full value of the material at risk and the reinstatement cost. The failure to understand how to arrive at a valid sum insured, and that's a particularly important point, I think. The failure to keep sums insured under review from year to year, that's fairly common. The failure to obtain up-to-date valuations. Now, we're going to talk about valuations a bit more later, but they do come into our daily vision quite often, frankly. Is that I saw a valuation the other day, it's 13 years out of date. And the insured said, well, nobody told us to do anything different. They shouldn't need to be told, but that was the answer. There's another thing which crops up from time to time, and I think it's worth making a note of, that some policies have sublimits in them. And this is usually with sort of various types of package policy. And quite often those sublimits turn out to be too little. And some of you may know or may not know that in the recent BI FCA matter, quite a lot of the sublimits in those policies did prove to be underinsured by quite a considerable sum. So that's another point for you to just take into account. The failure to consider the need to add VAT into valuations it comes up time to time. With regard to the brokers, there's lots of things that we can say about brokers and sums insured. The first thing I will say is that it is not the responsibility of the broker to arrive at the sum insured, but it is, and it's pretty much settled law, that the broker is responsible for guiding the policyholder as how to arrive at one. Another aspect which might shock you a little bit is there is, to our opinion, quite a lot of neglect, recklessness, or willful blindness of customers to take care in assessing the true values of the subject matter to be insured. Quite often this is because they don't care and they think, oh, we'll argue about it at the time, or I don't want to pay too much in insurance. So, but the point is, some of these things are neglect and reckless, and there are occasions when we see these things and we say, well, there's nothing we can do for you because nothing you did for yourself, and the insurer is quite right to be upset about it. There's another one, which is the deliberative intention of the client, of the insured, to pay as low as premium as possible, and so they deliberately lower the values at risk. No other reason that that's enough, and we'll come back to that later as well, because that has some interesting consequences. That's a good selection of the things that give rise to underinsurance. But I think fundamentally what we'd say is that there isn't enough information in the public domain, particularly on insurance sales websites, to really bring home to the person why it's important to have the right sum insured and how to arrive at it. And we'll come back to that again later, because I do think it's important. If you are interested, anybody is interested, the information that I've just given you, and quite a lot more, is available from BIBA, and it's in a booklet published in 2016 concerning their professional indemnity initiative, and it's book number 6, and it's all about underinsurance. And several insurers contributed to that, and it was really quite a useful piece of work. And I would commend you to look at it if you can get your hands on it, because it's a good piece of explanation about underinsurance. Now, let's move to the consequences of underinsurance. These can lead to, frankly, tragic and life-changing outcomes. Michael and I have to deal with these all too often. But most homeowners in particular, a lot of business owners as well, really don't have a clue about insurance, let alone understanding underinsurance. And the myths and misunderstandings about how insurance works and how average works, etc., it never fails to astound us. So there's no doubt about it that if we as an industry can do something to redress the balance by making this more publicly available information, we'd be doing ourselves a great service, I think. It's not difficult really to set out the principles of how to avoid it. And I'll give you an example. You could say, probably within 500 words, enough to bring to the attention of most policyholders, enough to satisfy a court that you've given them enough information upon which to make a safe decision. And let me just give you an example of a heading. Underinsurance, the difference between the sum declared by the customer to represent the true value at risk and the true value established at the time of a claim, loss or damage. Well, that's 32 words. And that says quite a lot. And if you can put an explanation under that, you might be able to get away with 100 words. But I think the common theme of this is that most people will tell us when we're dealing with a claim, we didn't know how to approach it. That's the root of the problem. So, Michael, perhaps you'd like to take us through the learning objectives, and we'll tackle some of the things I've just mentioned more deeply as we go.
Thank you very much, Roger. Incidentally, it seems that Roger's camera has frozen, but I'm hoping that you can hear him all right. So just running through the learning objectives, to understand the importance of insuring for full value, to review ways for the insured to calculate the value at risk, to review existing methods of keeping sums insured up to date, to explain the pro rata condition of average, to examine when average will apply and when it doesn't, and to understand the difficulties encountered at the claim stage. So the first thing that the insured needs to do is to establish the value at risk. And we still see on enquiry forms, particularly through the online aggregators, some rather unhelpful questions such as, what is the value of your property? So although this is very basic, clearly we need to get across the fact that we're looking at the actual value at risk. And for personal lines, the best point of contact is the ABI BCIS assessment tool. Quite often this is not pointed out to consumers, and the BCIS is the Building Cost Information Service, and the facility that they have through the ABI website is really, really helpful. It explains it in very simple terms. It caters for standard properties. Clearly, allowances have got to be made for properties that are particularly old, or they're listed buildings, or they're made of non-standard materials. But nevertheless, the ABI site is a natural starting point for consumers. That facility does not extend to business insurance. There are a number of desktop valuation services available, but we always think that, particularly for a new risk, it's just as well for the insured to instruct a chartered surveyor with the clear instruction to produce a valuation based on the full rebuilding cost, which, as we know, includes the cost to demolish and professional fees and what have you. So there's plenty of help available, and we still get the opinion that there are far too many policyholders who are just putting down a gut feeling as to what the figure is, or sometimes going back to consumers, they're going online looking for quotations, and so they just put in the first figure that pops into their heads for the purposes of establishing what the going rate is for the premium, forgetting to go back and do the job properly. And of course, indexation comes into this. Roger, could you just introduce indexation?
Yes, one of the things about indexation, we often see policies that they say they're index-linked sums insured, but there's still an element of underinsurance. Now, this is actually a more vexing problem than it should be, and I think it comes from possibly time and distance. This is how it's always been done, so why should we change it? But as you probably know, recently, in the last couple of years, we've seen massive increases above inflation in the costs of materials. An average, I think, of 19% was mentioned, and certainly some materials have gone up by 25 or more, and I'm aware of some claims that we've got where steel's gone up about 75%. And it makes a nonsense of the indexation of the policy. Now, the reason for mentioning this is that looking at it from our perspective, which is what happens when it goes wrong, it's reasonable to say that a policyholder that sees a policy that says your sum insured is index linked, their interpretation of that will be, in that case, I'm not going to be underinsured because somebody's looking after me to tell me to keep my sum insured right. Now, of course, that is only true to the extent that the original sum insured was right. And the original sum insured needs, in every case really, some degree of valuation of what its reinstatement cost is going to be. Commercial property, there's more incentive, I think, for people to do that because it's a business and it's part of the business expense. Residential private property, there's less incentive for most people to do it. And it's going to incur a cost, and I'm sure a lot of people just can't be bothered. But the fact is that if you say there's going to be an index linking, there is an implication that it will protect the insured. And when it doesn't, the question is, well, what went wrong and who should pay the difference? In some cases, we have to say the broker has had to pay the difference for failing to advise the insured, even on consumer cases, and certainly on some business cases. But one of the things that occurs to us is that it wouldn't be a bad idea, particularly now at times when we are looking at pretty unpredictable commercial situations and pricing of just about everything, to say, well, look, let's say what the index link is going to be, whether it's going to be 3%, 5%, or a public or statutory index link, whatever you want to do, but make it clear to the insured what that index linking is based upon. But in addition, point out, if you can find a way of doing it, and I think it's not too difficult, to say that index linking is only based upon an average of, if you like, property prices, building costs or whatever, taken from such and such a suite of information over a period of time. What it doesn't do is guarantee that that index will be enough. How we get that across to policyholders is a matter for the industry to work out for itself. But I'm simply reporting the fact that we're getting more of these come into us. And this obfuscation as to what index linking means gives rise to disputes and unfairness in the outcome of the contract. Because the policyholder has done nothing wrong if they've followed the online instructions for providing the information, as long as they have been reasonably diligent in putting in a sensible figure, then you can't really criticise the policyholder, but they can still come unstuck. So,
Roger?
Yes.
There are times, aren't there, when no matter how well the indexation is organised, that the value at risk can still fall behind. And there are times when an insured will need to look at this mid-term, particularly at a time of very high inflation. But in addition to that, we sometimes talk to brokers about how often do you recommend your commercial customers in particular to carry out a resurvey. And some would say every 3 years, some would say every 5 years. But from your experience, would it be true to say that that conversation about resurveys probably doesn't happen often enough?
Well, it doesn't happen often enough, and we know that because of the statistics on underinsurance. The point is that underinsurance can largely be cured if you take time to find out what the reinstatement cost of the property is going to be. That's the golden starting point. But people don't know how to do it, or they veer away from it from time and cost. There's all kinds of reasons. But I think what you're saying about the mid-term review, I have a view, and it won't be particularly shared by everybody, I realise, that it's unreasonable to expect a policyholder to review their sum insured mid-term of most policies unless there's a good reason to do so, like you're having work done and you're increasing the size of the house, or you're changing something substantive within the property, taking a property and bringing it up to a modern spec or something like that. And I can understand from an insurer's point of view, they say, well, it's the duty of the insured to do it. And it might be, but I think in real life, most people don't think about insurance either past the renewal date or until they have a claim. So I view the idea of mid-term reviews as a nice idea, but I just don't think it's going to happen unless we have a much heavier handle on maintaining a relationship with the insured. And of course, in modern insurance, that's the last thing we're doing. We're moving further and further away from them. So I think that's all I have to say on that, really. But my view about revaluing is I've worked for a long time, some people may know, with the RICS as their insurance advisor on surveyors' negligence matters. So I've got a pretty good handle on how it happens, why it happens, and why it doesn't happen. And the truth is that if you get 3 surveyors to value a property, you'll get 3 different figures. There's plenty of case law on that. If you get 3 surveyors to say what are the rebuilding costs of a property, you'll probably still get 3 different figures. In fact, I've got one on my desk at the moment exactly like that. But if those figures are contemporary and they're, shall we say, within 5 or 10% of each other, that's pretty much good enough to be able to say that there was no underinsurance, or certainly there was no negligent or careless underinsurance. And that's really, I think, where we need to get to.
Well, thank you, Roger. So we're probably all familiar with the condition of average. I put on the slide here what you might call a typical textbook definition, which from memory, I think I took from my old CII examination booklet. But I rather like the one that you came up with earlier, Roger, which I'll read out again. Underinsurance is the difference between the sum declared by the customer to represent the true value at risk and the true value established at the time of the claim, loss or damage. And maybe we could play around with these words and come up with a definition which a typical policyholder is going to understand, because we've already established that when it comes to underinsurance, a lot of the problems are down to a lack of understanding. But this definition will be in our fact sheet, which will be available to you at the end of the webinar. And when it comes to adjusting a loss for average, it's fairly straightforward. It's the sum insured in the policy divided by the full value at the time of the loss multiplied by the loss. And that's a fairly simple explanation of how it works in practice. Now, we also need to look at when average applies and when it doesn't. And the history of the average condition might come as a surprise to some of you, because prior to 1967, which was even longer ago that Roger and I hadn't even entered the business by then, but prior to 1967, the condition of average applied to a very narrow range of insurances. When the condition was applied more universally in 1967, it was not applied to policies including insuring domestic property at all. Nor was it applied to policies insuring property that was privately owned, even if it was occupied for trade purposes. So it was quite restricted. So when insurers apply average for claims under personal lines policies, and probably property owners insurances too, it's often expected that there would be some leeway consistent with the original intention that private individuals should not be treated as if they were a business. So even today, a traditional standard home insurance will not include an average condition, but increasingly more of them do. And the only way to know if a domestic insurance includes an average condition is to read the policy. But even in cases where there is an average condition, and I've noticed this reading some of the financial ombudsman decisions, that there is a little bit of leeway. The policyholders usually cut a little bit of slack. And the general principle that we believe should apply is that as long as the consumer has made an honest stab at getting his sum insured right, taking the advice, using the ABI tool that we referred to previously, that consumers should not be inappropriately impacted by the application of average if it would give an unfair result. And if you're interested in this, it might be an idea to look at some of the FOS decisions on this. It's not quite as clear cut as it would be under a typical business policy. The other thing to mention, of course, is it particularly under business policies, but sometimes under, say, property owners' policies, there's quite often a 15% safety net. So you're not underinsured as long as your sum insured covers 85% of the value at risk.
Can I just add something, Mike?
Yes.
Just for purposes of clarity, most indexed policies will take the sum insured for the expiring year of insurance and increase them by whatever the indexation is. That is the sum insured for that ensuing years of insurance. It doesn't go up by a further index linking unless there is another condition in the policy or coverage clause in the policy that says it does. Now, there are policies that do that. Michael will come on to one later. But just to understand that when we're talking about index linking, it's normally retroactive. In other words, you come up for renewal and somebody says, your sum insured is now increased by 5% over last year. Is that sufficient? Now, what we're saying is that very often is proving not to be sufficient. And that's the problem we're trying to address. Just make that clear.
Thank you. Well, we've got some examples to work through. Roger, you're going to take us through the first one. And as you'll see from the slide, this particular case ended up as a complaint against the broker. So what was going on this case, Roger?
Yeah, this was an interesting case. This was a chap who wanted a competitive quote, as most people do, for the insurance. And at the time, he had an insurance on his property for £500,000. So one of the questions, the question posed in the aggregator, what is the value of your buildings? Now, we could have a seminar on what that question means, but that's another matter. The proposer simply said £500,000 because that's what he wanted. What he was really doing was comparing how much the premium was going to be with this insurer from his previous one. So he provided that, and that was then transferred to a broker's site, and the broker carried on the transaction. Now that resulted later on in a claim where it was decided by the loss adjuster that the value at risk was actually in excess of £1 million. So the claim was accepted, but average was applied, and the claim was reduced by just over 50%. Now, once the claim was settled, the policyholder complained to the broker for not having advised on the meaning of value at risk. And after the broker's complaints procedure, it was referred to the FOS, and the FOS upheld the complaint against the broker. Now, in our view, this was a bit unfair, because when we saw the broker's documentation, it actually did make it reasonably clear what was required of the policyholder to avoid underinsurance and also to make a fair presentation of the risk. But what the FOS said is that it was tucked away in the kind of information that people don't usually read. And also it didn't include a guide as to how to calculate or arrive at the sum insured. Now, I can say that going back to what I referred to earlier in the introductions, the Bieber booklet on this subject, that was one of the things that it majored on. Actually, the broker's job is to guide the policyholder is how to arrive at the sum insured. And there's recently been some very good case law on this, on a very high profile BI case. So I am absolutely in no doubt whatsoever that if you're advising a customer, then it's not good enough to say you should take care. Actually, the test now, and even the FOS have come to this, is you need to show them how to get there. And we could debate if there's time, with a number of ways of doing it. But that's the standard that's now required. Michael, over to you.
Yeah. The next example was a school, and this was a buildings insurance done on a day one basis. So under a day one basis, the insured makes a declaration of rebuilding cost. And the advantage of a day one policy is that the policy incorporates an automatic inflationary margin, perhaps 15%, maybe 30%, which protects the insured in the event of a major rebuild that might take some time and will cater for inflationary pressures. But of course, the declared value must be an accurate statement of the value at risk. And in this case, the insurer estimated that there was 13.19% underinsurance. That wasn't a huge level of underinsurance, but it was enough to make a serious impact in the value of the claim. So we look at cases like this, particularly where the percentage of underinsurance is not particularly large, that we're a little bit concerned that sometimes that can be within a margin of error. And when we looked at it more carefully, we were a little bit unhappy with the loss adjusters' estimates for the rebuilding costs. We felt that there was rather too much built into the figures for professional fees. It wasn't a standard percentage. And also the loss adjusters' figures had included quite a sizable amount for a contingency. Now, it's quite normal if you're a building contractor estimating for a job to build in a contingency, but it's not normal insurance practice to do that if you're establishing a declared value or a sum insured. So in this case, we had a good discussion about the figures, and in the end, the insurer was happy to accept that there hadn't actually been any underinsurance. But the value of mentioning this case is that whether you're working for an insurer or whether you're working for a broker, particularly where the underinsurance is within a fine margin, such as in this case, it's always worth just checking and double checking the figures to make sure that there's not been an injustice. This is a fairly straightforward case, but had catastrophic impact for the policyholder. It was a home insurance where the true value at risk was 1.3 million, but there was a sum insured of only £650,000. And this policy did have an average clause in it. So just to illustrate it, this was a total loss, so that the property was totally destroyed, and so therefore the claim was based on a total rebuild. And just to illustrate that in a case like this, that where you've got a sum insured which is half the cost to rebuild, ordinarily you would be saying that there would be a 50% average applied. But in a case like this, where it's a total loss and the total sum insured is payable, in this case £650,000, that is the amount that the insured receives. You don't look at the sum insured and say, oh, well, you're only entitled to 50% of that. We have come across that suggestion, and it's wrong. And actually, it fails just on the basis of mathematics. So in a case like that, there is no additional reduction for average. Another example here, which Roger, I think you're going to take us through, because there was a discussion here about index linking throughout the policy.
Yes, this was an interesting case. This was with business premises. The insured policy incepted on the 1st of January, and a fire occurred on the 20th of January the following year. Sorry, not the 31st of January. So it was just within the year. So the 31st of January inception date, 21st of January following year, fire occurred. And the loss adjuster took the view that the sum insured was far too low and got in a surveyor to compile a report to establish the adequacy of it. And then what happened was that they raised the question of whether the date for establishing the true value at risk should be the date of inception of the policy, i.e. 31st of January, or the date of the fire, which is nearly 12 months later, or the date that reinstatement was expected to commence. Well, the sum insured, unsurprisingly, had remained unchanged since the original inception date. And it was recognised in the surveyor's report that the period, that 12 months, had been a period of high inflation. And it was identified that the insured's position would be better protected if the date used was the renewal date, i.e. 31st of January. But insurers maintained that the sum insured had to be adequate through the policy year. And so the valuer was instructed to use that date of the fire. Now, what then happened is that I think lawyers got involved, or somebody did before us anyway. And the view expressed was that they found that there was, in the policy terms, which they'd missed before, there was a clause that said not only was the sum insured index linked from the 31st of January, but it was index linked on a monthly continuing basis. And on that basis, the index linking was calculated to remove quite a considerable amount of the underinsurance. So the point about it is that indexation, this is a good example of saying why indexation it can be a confusing issue, because the loss adjuster, the lawyer, and the insured and the broker all had different views about it. And what we need is some kind of level playing field about what is meant by indexation. If you say that a policy is index linked during the period of the policy, which I haven't seen one, apart from this, are you going to get a situation where you insure your building for, say, let's take a figure, £100,000, and then during the year, the indexation takes it up to, say, £127,000? Very unlikely. It's not the way that insurance has traditionally worked. So what we need to do is to come back to some kind of basis and say, well, how are we going to explain this indexation? And how are we going to look at indexation on the one hand, which is usually based upon an RPI index or something of that kind, in contrast to the massive inflationary issues that are not necessarily linked to the RPI, and therefore there's that gap. That is the issue that we're dealing with. And in this case, the insured came out rather better than he thought, because he'd taken care to do it. But fundamentally, what we would say is... Sorry, go on.
Sorry to come in. I suppose we could say that there are three types of policy.
Yeah.
The first one is a policy that has no indexation.
Yeah.
The second policy will be one that's index linked at renewal,
yeah,
but at renewal only. And the third type of policy is the one that's indexed at renewal, but there's a clause that provides for continuing indexation throughout the year.
Yeah.
Now, and again, there's no uniform approach to this. One just has to read the policy. Now, the whole industry focuses on encouraging policyholders to establish the value at risk on the first day of the insurance.
Yes.
And if you're a consumer and you use the ABI BCIS tool, that will give you the value at risk, or the suggested sum insured, as at the first day of the insurance.
Yeah.
But until you've established what type of policy it is, as far as indexation is concerned, you don't know whether to do your own uplift.
No, that's the whole point, isn't it?
Because,
And what I was about to say was that actually the reinstatement cost needs to be the cost on the last day of the policy, not the first. But people aren't geared to thinking that through. But that's how it will be interpreted by a loss adjuster or by the insurer and say, well, you haven't got enough money today. So in this case, when the work started 8 months after the fire, in other words, August of the same year, after renewal, by that time, the inflationary costs had gone up even further. And it was a nightmare. It was a nightmare. But the point is, the policy didn't address the problem, and nor did the insurance sale process address the problem. And that's what the complaint was about, is that nobody told me I had to think like this. And all I'm saying is that it's so logical, isn't it, that if you're going to have your house rebuilt after a fire, or your building, doesn't matter if it's a house, whatever it is, if you're going to have something rebuilt after a fire, you must assume it's not going to be the next day. It's probably going to be several weeks or months later. And therefore, the cost you will pay for that will be the cost that is prevailing at the time. And the question you have to ask yourself is, has my sum insured, is it enough to pay for all of that cost? And if the answer is likely to be no, then you're underinsured. And that's the simple way of looking at it. But we don't, as an industry, look at it in that light. And that's what Mike and I are saying, that, in this webinar, it really is something that you can give reasonable attention to, particularly if we're going to continue to see unprecedented ranges of commercial reinstatement costs.
Thank you. Let's just consider the broker's role, because I'd like to leave some time for questions and answers.
Yes.
Yes. We forming the view increasingly, aren't we, that the broker's role is increasingly vulnerable.
Yes.
You mentioned before the case that went to the ombudsman, Roger,
yes.
And when we looked at that, we were rather surprised at that decision. And then, of course, when a broker has a case that goes to the ombudsman, their professional indemnity insurers will doubtless be involved. And even a case that doesn't go to the ombudsman, even if it's just a complaint that hasn't gone that far, quite often a PI insurer will take a pragmatic view and will encourage the broker to make an offer, rather than risking it becoming a huge claim and incurring a lot of legal fees. So a lot of our thinking is trying to encourage the broker to find ways to communicate, particularly on matters of underinsurance, not just in a clinical, factual way, but in a way that's going to best communicate.
Yeah, well,
you come across quite a lot of these issues with your expert evidence work. Have you got any additional?
Well, I think that the problem is this: that brokers are increasingly judged by standards which are based upon what other professions do. Now, other professions, and here, we'll just take, for example, surveying, accountancy and law, just for the moment. That's enough. Each of those professions are giving advice, and they get a fee for giving advice. The insurance industry is not yet a profession, and it doesn't give advice so much as arrange a transaction. So the dynamics are different. It might give advice in conjunction with the transaction, but A, it's not charging for it, and B, it is becoming increasingly difficult for many brokers to give advice to people that they never see or meet and can only communicate through increasingly tech and eventually AI. Now, the courts are taking a different view, and I'm there often enough to know that they're saying, well, no, if somebody is a broker what is the broker getting paid for if he's not doing something which advises and doing something that the client can't do for himself? And very often that subject is ensuring that there's no underinsurance. I can't tell you how many cases I've had in the last 2 or 3 years where even, big brokers, small brokers, medium-sized, it's not size specific, but the inattention to detail on matters of sums insured and how to calculate them, not just on property, but on BI as well. That's a really, really growing issue. Is the courts will say, if you hold yourself out as an advisor, i.e. a professional, you will be judged by professional standards. And those professional standards are well documented in law, and they apply to all professionals, and brokers aren't going to, for any reason, sit outside that pot of what is a professional duty of care. That's the problem. It's the law is saying we expect more of you than just putting a note in the letter saying it's up to you to find your sum insured and to make sure it's right. And they're saying it's not enough. The FOS is now saying the same thing. And I think that this is going to be an increasing and creeping problem. It doesn't just apply to sums insured, it applies to all kinds of other things concerning terms and conditions in policies. And I won't go into all that now. It's not the subject of this webinar. But I think the way to look at it is this, that if we can use technology, InsurTech and AI as it's coming, to better inform the client, the customer, the policyholder at the time of arranging the contract. So when somebody goes onto an aggregator site, they're not asked basic, simple questions. They're asked to give some proper information. And if they don't want to give the proper information, they don't get the quote. Now, of course, that will destroy a lot of insurers' targets immediately, because people will say, I won't bother to insure. So that's not an easy answer either. But we've got to get to a situation where our industry is doing enough to satisfy the test of, did you give the customer enough information to know what he had to do in order to have a safe sum insured? The answer at the moment, we don't do it. The question is how we can do it. And if you're a broker, the duty of care will be higher than if you're just an agency seller. I think that's just the fact of the life at the moment.
Thank you, Roger.
Talk about that as much as you like.
Let's see if we can tackle a few questions. Back to Catherine.
Thank you. And as always, we have a lot of questions. And before I go back to the beginning, though, one question has come up that has said, average has been referenced a lot during the presentation, but there's been no reference to application of proportionate remedy on personal lines business. Why is this?
Well, it's a different subject.
I think what the question is getting at is that under the Insurance Act, where you've got a non-disclosure, and you could say that getting the sum insured wrong is a non-disclosure issue. If it's a non-disclosure issue, then instead of average, yes, you're quite right, the claim should be adjusted in proportion to what the additional premium would have been.
Yeah.
And sometimes on consumer insurance, that is in fact what happens. And in fact, one thing we didn't have time to cover is that particularly in consumer insurance, in a case of very serious underinsurance, some insurers will elect to void the policy and pay nothing. And that's a discrete issue which probably needs to be treated separately. But yes, the question is quite right. But ordinarily, we find with consumer insurance, it's subject to average rather than proportionate to the
I think it's a very good question, Mike. I mean, it's a very fair question. The point is that we were tackling specifically the subject of average because it's often so easily misunderstood or misapplied. But that subject is probably worthy of a webinar in itself because it's a comparatively new concept, of course, since only 2015. And we're already seeing a high variation on the theme of how the remedies should be applied in practice. There's no consistency of it at all. So maybe we'll come back to that on another occasion.
Thank you. So going back to when we first started the webinar, there's a question saying, does the insured delegation of the calculation to their accountants to establish asset values and BI calculations sometimes cause problems in assessing the insurance definition of a sum insured? And the example is, would an accountant include salaries in a gross when an insurer would? To what extent should brokers challenge this calculation?
Right. Well, there's a very good answer to that. And it's not a technical answer, but the answer is this. There was a case, and I can't recall the name of it off my head at the moment, but I was reading it only earlier this year, where exactly that happened. The accountant was delegated the job of coming up with the business interruption sum insured by the broker on behalf of his client. And the accountant did a reasonable job. And the broker had actually supplied the accountant and the insured with a guidebook as to how to calculate business sums insured, BI sums insured. And what happened was that was followed, not meticulously, but the judge said it was followed by about 90% of what it said in that guidebook. The problem is that it was the wrong guidebook. And what had happened, the broker had written a generic guidebook to how to calculate business interruption sums insured, but hadn't included the nuances of what the questioner has just asked about salaries and different types of gross profit or revenue type policies. And the point about this is what the court said is that the broker failed in its duty to properly guide the client, the insured, because the guide that they had used to guide the insured was in fact not compatible with the policy that they had chosen to sell the insured. Now that goes to the heart of the issue. It comes down to detail. And on the basis that we all know that one of the humongously great weaknesses of insurance contracts in the modern world is that there are thousands of them which appear on the surface to be offering the same cover, but they use different words, different expressions, different terms, and different conditions. And they're subtle difference, but those subtleties make all the difference at the time of a claim. And so the answer to the question, I think, is you've got to line up your guidance. If you're going to delegate it to an accountant, you've got to say, here is the policy I'm going to sell them. Here is the definition. This is what the definition means. Please come up with the figures. Because the accountant won't have a clue otherwise, in which case the broker will be responsible. Does that answer the question?
I think so.
Thank you. And the next question is, where the level of underinsurance might be considered a failure or of fair presentation? What are your views on the insurer using PR as a remedy rather than applying average?
Can you say that again?
Where the level of underinsurance might be considered of fair presentation, what are your views on insurer using PR as a remedy rather than applying average?
Well, if it's a matter of fair representation, it goes to the heart of the contract, the root of the contract. And that's what Mike was telling you just now, that can lead to voidance. So the question is, what is the remedy when the alternative is voidance? Mike, I know you've got some views on that, so now's the time.
Well, I would say that voidance would normally only apply in a case where the insurer maintains that had it known the full value at risk, it would not have offered the insurance in the first place. And so therefore the policy is void from inception. Such arguments are usually difficult ones. And again, we might need a webinar just on that. But I think the questioner is probably getting more at the case of what you might call ordinary underinsurance. And so therefore you've got you've got a potential conflict between what the policy says, which says that the claim would be settled subject to average, and the conflict is that the alternative way of dealing with the problem is to settle the claim in proportion to the extent to which the premium was too low because of the understatement of value. Now, some policies now write into the policy that that's precisely what they're going to do. But from our experience, bearing in mind that we only see the claims that have gone off the rails, we would expect that the proportionate remedy in relation to the premium is unusual. And if the policy specifically contains an average clause, then we would expect that average clause to be the one that applies.
I think also it's fair to say this comes very much in the heart of consumer outcomes. The whole principle of the outcome. Was the underinsurance so severe as to cause alarm? In other words, why? Was this deliberate? Was this reckless or negligent? Or was it a genuine misunderstanding? And I mean, I'm old enough, and there might be a few of you on there this morning that was old, to remember the days back when I started in the 70s, when insurers would often say about a claim, "Oh, well, he's been with us a long time, we'll pay that. That was a mistake, he's a good bloke, really." Don't get that anymore. I haven't had that since about 1990. But the point is that the issue is what is a fair outcome under all the circumstances to this insured under these circumstances. So answering questions in a sort of a vacuum of subjectivity is never a really good idea. I think the answer is proportionality can be a good remedy when it's appropriate, and what is appropriate when it is really a matter of the facts at the time. But I would encourage insurers to use it instead of the application of average, if by doing so it improves the awareness and knowledge of insureds generally towards keeping the sum insured right. Could be a good marketing tool.
Thank you.
I've got
quite an interesting question. In cases where index linking pay the difference.
You broke up there, so I didn't hear it all.
Okay, sorry about that. In cases where index linking is not made clear, can the insurer be made to pay the difference?
Well, that's the burning question. That's why we're here, because that is the suggestion. And that is very much a law-specific matter. Believe me, there is no easy answer to that question. But the way to look at it, to start to look at it anyway, is did the insurer take reasonable steps to ask clear questions that would put a reasonably prudent insured or uninsured in the position of knowing what was asked for and how to deliver it. You could have a massive debate on this subject. My opinion is that the insurance industry in recent years, as it has tended to do away with proposal forms in the old-fashioned way, has come up with huge number of different ways of asking apparently the same question. And that is misleading. And that's the kind of thing the courts will light upon. In fact, they did in the FCA litigation. If you read, that's one of the points they made. You're asking the same thing or saying the same thing in different words. What did you really mean? And the industry is not good at that because it's competitive and it doesn't want to copy somebody else's wording for fear of competition law and all kinds of things. But that's what it comes down to. So I don't think there's an answer to the question, but I can tell you from my experience of 25 years of doing expert work, in a case like that, the first thing they would do would be to look, is there a broker to sue? Because it would be an easier target than going to sue the insurer. And the broker would remonstrate with them and say, well, actually, it's not our problem. It was what the insurer said. But the insurers will have take a strong stand and say, no, it's up to the insured to ask us if they don't understand the question. And you can't disagree with that, except that how can they get to the insured? And that will be the next question that will be tested in that process. I mean, I'd love to talk about this for longer because it really is a fascinating thing, but it's very complex, that question, or the answer rather. It can be very complex.
And our time is up, unfortunately.
Thank you very much to you both for delivering this webcast today and for all the information shared. This session will now also be available on demand, and please feel free to share the webcast with anyone you think would benefit from it. Keep an eye out as our Flaxman partners have a number of webinars running throughout the year for you to benefit from, so you will see Roger and Michael again. Thank you to all delegates for joining us today, and we hope you have a good week. Goodbye.
Goodbye.
Thanks.